Hey, it's Jim, and this is level 3 of the CFA program, the private markets pathway, and the learning module on general partner and investor perspectives and the investment process. And here are the learning outcome statements. As you casually glance through these, what I want you to do is go back to the level 1 LOSs on a mutual fund manager. And I think some of the good questions that will show up in this section might be the differences between the two. So if I go through these quickly here, what does a mutual fund manager do? They just accept our money, right? And they invest it. So they have roles and responsibilities. But here inside of the private market, that role that the mutual fund manager plays now goes to the general partner. And the rest of us who invest in this fund, this private fund, we become the limited partners. Back in the mutual fund days, we're just regular old shareholders or investors. What that means then is that the general partner has specific roles and responsibilities that are probably a little bit more advanced and go down different paths than the regular old mutual fund manager. Notice in the second one, we're going to have to calculate. Of course, mutual fund managers want to get compensated, but they get compensated through things like, management fees and expense ratios. For private investments, we're going to have to do management fees, but we bring in the specter of carried interest, which carries a lot of political weight to it. So we have a problem in here, and I'll show you how to calculate that carried interest. Now, what the mutual fund manager does is go out and find stocks and bonds to invest in. But now, in the private market, we're actually going out and investing in unique and private, they tend to be small, but they don't have to be, firms. So that's why we call them targets. And those targets are going to be the source of value creation. And so that third LOS really is nothing more than a capital budgeting problem, right? The private fund manager is going to find projects that have positive net present values. Of course, everybody out there in the financial services industry works hard, but you guys know, and you've listened to me before, due diligence, this is super important. Now, the exit routes in regular old mutual fund stuff, that just involves picking up the phone, calling the manager and say, hey, I want my money back. And they send it to you, fairly quickly. But here, since we have all these extra responsibilities and roles, we need to figure out how to get out of owning a business. Now, back in the old days when I was going through the program, this is, over 2 decades ago now, there were 18 study sessions and these chapters, they seem like they went on and on forever. But several years ago, as I'm guessing you guys know, the Institute chopped these into smaller learning modules. So what I think is really cool, what the Institute does now is they tend to, not every learning module, but they tend to give you kind of some background information, maybe a little bit of a history lesson, maybe some, current market data. But what the Institute is really trying to do is remind you of what stuff you should have remembered from back in level 2 and in level 3. So the first couple of paragraphs inside of this learning module are really just a reminder of a couple of important things. Notice the second line in there, specialized knowledge by that general partner. And we need to worry about not only business cycles, but investment cycles and maybe some other kind of cycles. Those of you who remember 2022, high levels of inflation in the United States, maybe there's an inflation cycle out there as well. But look at the bottom. Remember that this private fund stuff is really just an extension of what the Institute used to call, in general, like the alternative investment universe. And why are we doing this? Well, we're trying to manage standard deviation, right? So what we want to do is we want to increase returns without increasing standard deviation. And in fact, maybe because of a lack of correlation, we get diversification benefits. So maybe, just maybe, we can increase our expected returns while lowering total risk. Harry Markowitz might have something to say about that. All right, so here's a couple of slides here. Watch this. I'll go ahead. There's private market. Here's public markets. And so these are probably really good, simple introductory questions. Public market funds, you know all of those colors there going down the left-hand column. Here's the private market. So instead of open-ended, they're closed-end. They're not liquid. and they're in a fixed term. They require lots and lots of capital commitments early on. You can get into the Vanguard mutual fund family for, what is it, $2,500 or $3,000. But here in the private market universe, $3,000 probably doesn't get you hardly anything. Probably $300,000 doesn't get you much. Maybe $3 million or $30 million. Now we're talking, right? So I think one of the really good questions is this focus on early stage companies or mature companies. But this goes back to exactly what I was saying just a few minutes ago, is that we need growth opportunities. So early stage companies, clearly they have nothing to do but growth. The growth could be super. Of course, they could go to a valuation of 0. But mature companies have these established products. Maybe they even have branded product lines, but there's room for growth in there. And so that's pretty much what the Institute is telling you with that high return potential. There we go. Add value. That just means, hey, let's go ahead and compute net present value, make sure that it's positive, and then we need to work really, really hard to make certain that those expected cash flows materialize sometime in the future. So let's start with that first LOS. We did this curve back in the previous recording. And by the way, what I was saying earlier about the old time CFA program applies here as well, is that this second learning module is really a complement to the first one. If they would have done this long time ago when I was going through the program, this would have been just one big old chapter inside of a study session. But this is really the investment life cycle. We did this back in the previous recording, so I'll just do this quickly. So pre-commitment, commitment, then deployment, and then distribution of capital and exit of the investor. So I'm guessing that you remember this little J-shaped curve. So the takeaway here is negative cash flows during those first three pieces of the cycle, positive cash flows. And hopefully, that negative cash flow, can you guys see my hands here? Doesn't dip way down and then goes way up there. This is essentially, it's not exactly, but it's essentially, what capital budgeting is. You spend lots of money today, you invest lots of money today, and the marginal benefits occur at some time in the future. So let's go through this in just a little bit more detail, and I want to take you through an example that is going to help you throughout this learning module and maybe even give you some point of reference for the exam. There was a company called Corp that was created, 7 or 8 decades ago. And it was created by a dude who was a big golfer, and he loved golf, and his family loved golf. And so he decided to open up, this kind of a private firm in which he would start buying golf courses. And so they bought a golf course over here, they bought a golf course over here, but they had specialized knowledge about golf. So they were golfers, but they also knew how to run golfing businesses. It's one thing to say, hey, I have a golf course, come play my course, but you have to do things like, cut the grass. You have to do things like advertise. You have to do things like plant trees and all sorts of business ideas to go into this type of potentially, what did we say back here? We'll go way back here. Potentially high returns and diversification. So over the years, this Corp bought tons and tons of golf courses, and then it diversified. So think about what that means. It started investing partially in sports stadiums, in restaurants, in bars, and all sorts of kinds of really cool things that are, related to golf, but then, have some side light relationship with other kinds of sports. So you think about, as this company grew and grew, it needed even more and more specialized knowledge. I did look this up before I started this recording. There are around 15 or 16,000 golf courses in the United States. So there's great potential for growth. Now the idea for this Corp is to buy these golf courses that are undervalued, right? That are maybe diamonds in the rough, that all you need to do is plant a couple of azalea bushes over here, do something over here, and all of a sudden everybody wants to play your golf course. So there's tremendous potential for high returns here. Now, over the years, this Corp became bigger and bigger. It actually went public somewhere around 2010 or 2012, had an initial public offering. It became a public corporation, and its shares traded on a national exchange. And then 4 or 5 years later, it was taken private by Apollo Global Management Company. And Apollo, do a quick search on this, Apollo Global, they do everything, retirement planning, entertainment planning, all sorts of fun stuff. And so this Apollo, this is a management firm. So this is really a cool kind of a process here to see how you go from like the beginning in the 1950s, let's say, to the 2020s by owning golf courses and have different sets of the investment life cycle. So let's just think about this quickly. So what happened in the 1950s with Club Corp? We decided, let's go ahead and figure out which golf courses are out there. What's our area of expertise? Who do we have to hire? I mean, you have to hire, somebody who knows about grass, somebody who knows about mulching, somebody who knows about fertilizing, all that kind of good stuff. And then someone who knows about business and marketing and all that kind of stuff. So there we go. Due diligence in that pre-commitment piece of the life cycle. Then we need to get the capital commitment. So we need to solicit unfunded capital commitments from all of the investors out there. We'll call them limited partners. And we sign a limited partner agreement. Like when I invest in the Vanguard 500 Index Mutual Fund, I don't have to sign anything. All I have to do is say, hey, here's my money. They don't really care who I am, right? But we've got negotiations here, fees, rights, and terms. So this capital commitment. So think about it. This is the general partner who's an expert in golf and golf course management and all that kind of good stuff, starts raising all of this capital. So maybe in the 50s, gosh, I wouldn't even know how much this dude raised back in the 1950s. And by the way, I'm making some assumptions because, you really can't find the actual history of all this. Maybe it was 50 million, maybe it was 20 million back in the 50s, who knows? Then what do? We deploy the capital, right? So we go out and we start making these business plans for investments. We go say over here, all right, we're thinking about buying this golf course. And then over here, there might be a piece of land. Maybe we'll buy that piece of land and hire a golf course architect. Jack Nicklaus is still around. Maybe he could do it. Tiger Woods is getting into golf course design and construction, all that kind of good stuff. So we have all of this work going on during capital deployment. And then we have the financing and the refinancing phase in which we're go ahead and look at the very bottom. We're going to see the merger of acquiring and target companies. And we can do this with all different sorts of stuff that goes on the right-hand side of the balance sheet. Could be short-term debt, could be long-term debt, could be equity. Remember, these limited partners could be almost anybody. They could be interested in debt, but they could be interested in equity. I think about this, and it's not too similar, but I think the relationship is a little bit, it's strong enough for me to give you the analogy. You remember back when we had conversations for collateralized loan obligations and collateralized debt obligations, where you throw all these bonds and loans into one big pile and you slice them into different tranches, and you can assign values and coupon rates and anything you want to in each one of those slices. Well, you have a little bit of flexibility inside of the limited partner arrangement. And then the post-acquisition role. So this is just, okay, we're going to go ahead and run this business and see what we're going to do. We need to monitor the progress. We need to figure out what about capital drawdowns. And by the way, I'll show you a good example of this here in just a few minutes. And then we need to worry about how are we going to pay dividends and how are we going to get out. So this Club Corp went to an IPO, so those first investors, they got out with the proceeds of that initial public offering. And then they operated for 4 or 5 years as a public company. And then Apollo comes in as another private firm, and they take that company private. All right, so there's a different exit strategy. Who knows what Apollo is planning on doing with Club Corp? Either way, there are investors out there that are willing to pile on if, in fact, and I'll go back to what I was saying earlier, potential high returns and diversification. So think about, here's a little timeline or a little bit of this life cycle. So just think about Club Corp. And by the way, the name was, they changed the name to Invited maybe a decade or so ago. So if you type in Invited and do a search on that, and then Apollo, you'll get a little bit of a history on here. It's probably worth 5 minutes, if you don't have anything else to do while you're studying, to give you some kind of a point of reference to answer, managing these private investment funds. So we're going to use valuation techniques, of course. The problem is that if we want to value Procter & Gamble, we're not the only analysts out there that want to scrutinize and evaluate Procter & Gamble. I mean, there's tons and tons of information out there. But how much information out there is there on, think of your local public golf course, whatever that is. How much information is available on that? Well, the general partner is going to have to go out and sit across the street and say, okay, here's 6 cars in the parking lot, and there are 2 foursomes going down the 3rd fairway. And when these foursomes are done, they go in and you'll have to peek into the bar. They buy 12 beers and 6 hot dogs, whatever it is. So you're going to have to do this is all part of the due diligence. We're going to have to do this extra hard work by that general partner. All right, here's that LOS on calculate that you need to be able to do on the exam. So let's work through an example. So there's the management fee. That's just a fixed fee. We probably know that from previous conversations. And then performance-based fee. This is known as the carried interest. Some of the things down at the bottom of this slide probably are not too relevant for the exam. Higher management fees, that makes perfect sense. 1% for debt, 2% for equity. And then they're usually calculated as a percent of the total drawn and undrawn committed capital. You'll see that here in just a second. There could be some additional fees that throw in there. Some key considerations. This might be a good exam question. I like this one on the top right. Reduces potential conflicts of interest, because if you have the exact carried interest and management fee and advisory service percentage and all that kind of stuff out there, and it's outlined, there's probably not going to be too much of a consideration for potential conflicts of interest. I also like the one on the bottom left there, reduces the incentive for quick, less attractive investments. Remember that carried interest, and you'll see this in a second. That extends for what could be a longer time period. So the question becomes, and really this is the question, you know what you're going to get in terms of fees and costs and expenses when you invest in a mutual fund. Here, you know what you could potentially have to pay depending on performance and that committed capital, right? I mean, if committed capital is this much, well, that's one fee. If the committed capital is this much, well, that's another fee. So the general partner is going to be, or at least should be, well compensated if he or she is successful. And by the way, there are some awful golf courses out there that just are beyond repair and beyond anything to turn it into some kind of a profitable enterprise unless you just show up with a bunch of bulldozers and start over. Yeah, that carried interest, that's going to align the goals of both the general and the limited partner over that long time period. So this goes back to what we learned back in level 1 with the board of directors for a publicly held company. What do these chief executives get paid? They get paid a salary of $2 or $3 or $4 million, and nobody really cares about that. But the Wall Street Journal reports, every February or March, they say, oh, here are these 5 executives. They made $40 million and $50 million. So they make it sound like their salaries are super high, but most of that, in fact, sometimes almost all of that comes from the exercise of stock options. And so, I don't want you to think that carried interest and stock options are the same thing, but they have the same potential kinds of end goals. And that is to align the executive and the shareholder goals. But in this case, it's the general partner and the limited partner goals, right? Now, hurdle rate, make sure that you know that this is not the internal rate of return of the project. Even though we use the term hurdle rate in capital budgeting, this is just some predetermined, so that's important, predetermined minimum target rate of return, which is used as the benchmark for computing that carried interest, typically 15 or 20%. There's a hard hurdle rate, and there is and there's a soft hurdle rate. I'll show you those. I'll show you how to compute the difference in those two assumptions here in just a second. So here's our general formula for the general partner rate of return. All we're going to do is look inside of the parentheses, take the return on the fund, like the 1 period return, subtract out the hurdle rate, and that's going to be the formula for this general partner's rate of return. Notice that it could be zero, right? If the R minus the RH is negative, well, then that'll turn out to be zero. And that P, then that's the fee percentage, right? So carried interest is often deferred until 100% of the committed capital has been returned. So if let's say we sent $500 million to Club Corp over the years, that carried interest doesn't get computed or distributed to the general partner until that $500 million is returned. Now, when you have this soft hurdle rate, what this means, the hard hurdle rate is just what we did back there. That's just the R minus the RH. So there we go. Now, what you can do in this soft environment is you can say, well, you know what? If the general partner is successful, what we can do is we can go back to the very beginning and then pay that carried interest for all of the returns, not just the returns in excess of the hurdle rate, which then brings up this concept of a catch-up clause. So that means that the general partner can catch up this catch-up return. You'll see how that works here in just a second. So here's the formula, which looks pretty much like we just did, but we have a couple of other subtractions there. So I'll show you how to do this here with this example in a slide or two. Remember, we introduced this concept of high water mark and the clawback provisions when we did hedge funds. Gosh, I can't remember if we did that. I'm just assuming you guys did level 1 2 years ago. So it was either 2 years ago or 1 year ago in level 2 where we did the high water mark where, nothing gets paid unless you go back. And this is the high water mark and the clawback. These are important if in fact, the value, let's just call value of the assets goes up and then they go down. And so you can't get paid. The general partner can't be compensated for returning the fund to its original high watermark value. So that should make sense. All right, so let's go ahead and work through an example here. Let's see, successfully concluded its investment activities after 7 years. So this is one of those very early slides that, there's a fixed time period. Maybe it's 4 years, maybe it's 7 years, maybe it's 10 years, but it's not going to be an infinite number of years like owning a share of stock. All right, there we go. 150 million private fund investments, beginning of each of the first 4 years, and exited each investment 4 years after the capital deployment. So I'm guessing the Institute would give you a table that looks a little bit like this. In fact, this example is similar to one inside of this learning module. So you have this one to look at and one inside of the learning module. So there we go. Years down the left-hand column, 0 to 7. Committed capital for the beginning of each year, right? There's the 150. And so the capital drawdown, there's 30 and 40 and 50 and 30. So that they sum to 150 there. And then the cost basis of the exits. So there's the 30, 40, 50, and 30. So that's just a return of those original capital drawdowns. The orange column, additional cash inflows from investments. So the Institute would have to give you these things. Notice 6 and 15 and 18, and then they grow and then they fall again. So the net cash flows, minus 30 all the way to minus 12. Then we jump up to a 55 and a 52 and a 66. So this is that J-curve net cash flow kind of a thing that we did early on in this slide deck. A couple of other pieces of information that we need. Years 1 to 3, management fee 1.5% of the committed capital. But then in years 4 through 7, we need to take 1.5 of that committed capital less that cumulative cost basis. You'll see that's an easy calculation here in just a second. All right, 20% of the net return exceeding an 8% hurdle rate. In this early example, we'll do the hard hurdle rate, and this is applicable to each individual investment over those 4 years. We'll do no compounding of returns. That's a pretty standard assumption. All right, so let's go ahead and compute these management fees. All right, so what are we doing? Years 1 through 3, that's 1.5% of the 150. So that gets you 2.25 for years 1 through 3. All right, so that should be a super easy calculation. Then in years 4 through 7, what we need to do is subtract out, and let me go back here. So we're going to subtract out the 30 and then the 40 on top of the 30, that's 70, right? And then the 50 on top, so that's 120, and then the 150. So there we go, 150 minus 30, 150 minus 70, 150 minus 120, and then nothing in year 7. And so if you sum all those, you get 10.2 million total management fees over those 7 years. So let's figure out this carried interest part. So this was a simple part, right? Calculate management fees. Just think about that. It's just 1.5% of some number, right? But now we got to do this carried interest. What were we told? 10%. I'm sorry, 20%. So we need to figure out what those net returns are versus the hurdle rate. So we'll go ahead and look at those total net cash flows. So let's go back here. I guess we could have put a column down there at the far right, another block down on there. If you sum all of those net cash flows, you get 103 minus the 1020, right? We just calculated the 1020 there. So that gets you 92.8 million. The hurdle rate is going to be the 8% of the 150, and then don't forget to do it by 4 because of those 4 years. So what is 92 minus 48, whatever that number is, take that by 20%. So there you go, 8.96 million of carried interest over that 7-year period. All right, let's change the assumption here. Let's do a 10% soft hurdle rate and then a 10% carried interest rate. So let's go ahead and redo these calculations under the soft hurdle calculation. All right, so we've got this annual hurdle amount of $60 million. So that's just 10% of the 150. All right, so that first 60 million in returns is allocated entirely to the limited partners, right? So they need a return before the general partner can get any return. So after that hurdle is met, then that general partner gets to catch up. So let's do this catch up threshold down there. You can see that equation. And this is an equation. We do this all the time, right? You take some number and divide by 1 minus an interest rate, or 1 minus a tax rate, or 1 minus the flotation costs. So there you get the 60. I'm just going to say 67. I'm not going to say those 3 6s in a row, because those of you who are older and who've watched Damien the Omen, the last thing you want is for the devil to be popping out of your... If you've never watched Damien the Omen, I'm promising you don't watch it. It'll give you nightmares. All right, so what are we doing here? That catch-up threshold is 67, but our soft hurdle up at the top was 60. So the difference there is, about $7 million. So there we go. Catch-up carried interest, $7 million. So any returns above that 67 are going to be split according to that carried interest agreement. So all we're going to do is go back to that 9280 that we computed earlier, take out the 67, and that gets us 2.61. Add that to the 6.7 earlier, and you get 9.28 million. And what was it earlier over there? It was 8.96 million. So I'm guessing these are really good questions. You get a bunch of stuff like we've had here in the question stem. One question is to compute the 9.28. One question is to compute the 8.96. So I think that's pretty good. All right, so what kind of conclusions did we make? I think I said all those things. Let me give you another golf example to go through this latest LOS. Those of you who are golf fans will recognize the names of these golf clubs. But if you go back to, I believe it was around 1998, this is when Whistling Straits opened. And Whistling Straits is a great golf course that hosted a PGA tournament. I think it hosted a Ryder Cup event. Same thing with the Valhalla Golf Club, which hosts multiple PGA tournaments. You guys might remember Tiger Woods won one of his famous PGAs at Valhalla, but I think Valhalla had a Ryder Cup there as well. That goes back to 1986. So I want you to think about these two golf courses in the context of Club Hub and Invited in that earlier example that I gave you. At one point, At one point, these were just pieces of land. In fact, I think that Whistling Straits was like an army barracks or something in the 50s or 60s. Anyway, this land was then transformed into world-class golf courses. So think about those early days. This would be, considered to be a startup, high growth, maybe not a patent, but I mean, beautiful pieces of land and great architects. Jack Nicklaus was involved in one of those two. I think Valhalla. Non-financial milestones, like, hey, we're going to build a golf course here, and sooner or later we're going to have a major golf championship. Now, of course, after those courses opened, and by the way, it took, let's say 5 years for those courses to go from, the idea stage to the actual construction and then opening of the first tee. So those growth companies, as favorable characteristics in private investment targets, these would be golf courses that have established their reign. So, what did I say, 1998 and 1996 for those two golf courses. So maybe those first 5 years or so, that would be back here under startups and then growth. They have existing products. They've caught the attention of the PGA of America and the USGA, so lots of people are willing to invest. And now clearly those two golf courses are mature companies. Compare that to a golf course like Pinehurst, which has hosted multiple US Opens. That course has been around for well over a century. Strong market share, consistent cash flows. I mean, think of a golf course like Pebble Beach, which has changed ownership multiple times over the last 20 or 30 years. Anybody can play Pebble Beach, but it might cost you $400 or $200 depending on the time of day and the time of year. But these are clearly mature companies. Compare that to like the St. Andrews golf course that hosts the British Open. That thing's been around since maybe the 1400s or maybe even before that. How about real estate and infrastructure? Look at the pictures over there. Of course, real estate. This is all part of our golf course example. But the key thing here is that you are concerned about investing in current economic use and then future economic use. And I think my golf courses are really good examples because when those two golf courses opened, it was just a golf course, but then they had this future economic use. I mean, you go to one of these major golf tournaments, the four majors for the men anyway. I mean, it's massive amounts of people. Over 100,000 fans show up. So you think about going from just an old army barracks to an internationally recognized and watched sporting event. And then infrastructure, you probably have to learn something about the law, and you probably have to learn something about how governments work. If we're a construction firm and we want to help build a road or a bridge or any of that kind of stuff, so there's all sorts of insurance contracts that are out there, other kinds of contracts. And so real estate and infrastructure are linked here in this particular section because they have some commonalities, but there are some good differences as well. Now, let me just make a comment here. If you look at the 12 questions or so at the end of this learning module, there's really nothing that shows up in this section. But here, this is really a focus about sources of value creation. So we'll go ahead over the next few minutes talking about 4 key areas: strategic, operational, organizational, and financial. So look down at the bottom there. What are we trying to do? Improve performance. So this goes back to positive net present value and then drive growth at all of the stages in the life cycle, whether we're just a piece of land, whether we're constructing the golf course, whether we're opening the golf course, or whether we're high growth, or whether we're a mature golf course. We need to find new people to come and play our golf course. All right, so I think the good questions here, and look at the bottom of each of these slides. So that's probably the focus of what these good exam questions are going to be. So from a strategy, remember, let's just go back to a board of directors. It's the board's responsibility to establish the strategic direction. So product lines, new markets, acquire businesses. So what was I saying earlier about Club Corp? They did the golf courses, and they did the restaurants, and then they did the sports bars, and then they did some sports stadiums. So new product lines, expanding new product lines, new markets, acquire businesses, and then enhance distribution. And so that means that we need to have experts as part of the general partner's roles and responsibility in the supply chain on both sides. Operational, I think about this as almost fully on the left-hand side of the income statement. So over the top right, you have revenues, right? P times Q. And then over on the left-hand side of the income statement, you have all of the expenses. So what are we trying to do here as creating value, finding these key characteristics? Well, operational efficiency, this just means, let's make more of them instead of fewer of them so we can experience cost reductions due to things like, synergies or whatever it is. Process improvements, that's also an improvement in efficiency, but that process improvement, it probably includes both sides of the supply chain. The operational efficiency is just, right down the center line with maybe just a little bit of offshoots. And there on the left is what I was saying earlier, economies of scale, economies of scope. Remember, we learned this back in level 1, I think, with corporations. Bigger corporations, larger corporations from an asset standpoint and a revenue standpoint, they have more efficient access to capital, so they can borrow money at a lower rate just because of their size. Organizational, this goes back to board of directors. What kind of structure do we have? What kind of culture? What are some management enhancements in terms of providing compensation to the team on the golf course? Remember, the general partner is probably going to come in and not run every single golf course that he or she purchases. So there's got to be some kind of a management team, and that strategic direction has to come from the general partner, who is organizational and let me just go back here, operational and strategic, and then I'll go to the end, financial. So that general partner has to have expertise in all of those areas. And of course, the general partner is not going to be a superstar. Maybe he or she is a superstar, but they're going to have a support network, of course. So financial favorable characteristics, what are we looking here? We're looking at the balance sheet. So we want to make certain that we've got lots and lots of performing assets over on the left-hand side, and then that optimal mix of debt and equity over on the right-hand side. And of course, you can go back to level 1 and remind yourself about what Modigliani and Miller and subsequent researchers said about an optimal capital structure. But that's pretty much what we're talking about over here. And then, do we need to have some kind of innovation? The Institute calls this financial engineering, to be able to match the cash inflows versus the cash outflows. And then we'll talk a little bit in just a few minutes about some exit strategies. I mentioned earlier about the Club Corp IPO and then was taken private again. So down at the bottom, we need to worry about the application of each of these. So I think a really good exam question would be, hey, here's some strategies, here's some operations, here's some organizations, here's some finances. How does this relate to every part of that stage in the life cycle? Here's a quick side on due diligence. You've heard me say this before. It's just like putting your gloves on and your working boots on and going out and shoveling in the backyard. This is hard work. It's super hard work because we've got long-term commitments. We may or may not have access to lots and lots of data. We have no idea how to benchmark. What are the financing plans? How are we going to prioritize? All those good things. So this really is just a slide to say, you know what, work harder and then don't work less hard. Now, one of the interesting things, and I think this is a theme throughout this learning module, is the difference between, and I hinted about this at the beginning of this slide deck, the difference between a regular old mutual fund manager and a private investment manager. They have to have this special knowledge, specialized expertise. But recall that throughout the CFA program, the Institute is not asking us to be experts in microeconomics and macroeconomics and quantitative methods. They're asking us to know, a pretty high standard of that stuff, but we don't want to be, the superstar in each one of those fields. However, the general partner has a lot of pressure on him or her. And so the idea here is that we need to make certain that we know the macroeconomic environment, we know the industry environment. So that means if we're doing my golf course example, knowing all about golf course management, the history of golf course management, what has succeeded, what has failed, why do people actually come to play golf? And how can we increase that demand? So you need to know about the macro economy. What are the level of interest rates? What is employment, right? If people aren't working, they're not going to play golf, right? Lots of people think golf is a leisure activity. I have lots of my friends and family members who would think that it's not a leisure activity. It's a source of fun and enjoyment and a way of life. So don't forget macroeconomic variables and industry variables, and make certain when you are looking at an industry analysis, you always look at the competition and you always look at the industry growth rate. Those are probably good hints for exam questions. Those are the kind of questions I always ask my students. All right, how about these data rooms? This is an interesting concept. So let's suppose I'm the general partner and I have a whole bunch of golf courses over there that I'm thinking of buying, and I come to you guys and I say, hey, I need $30 million from each of you. And you say, all right, Jim, golf sounds like a good idea. I watch golf on TV. It doesn't sound too exciting unless there's a major going on, but I know a lot of people play golf. But how can you convince us other than just what we know? Yeah, so what happens then is that we give access to these potential limited partners, right? Potential investors to take a look at the golf course data. So if we have this golf course over here, suppose it's a public golf course, we'll go in and we'll visit and we'll talk about what is the demand for it. So we can actually look and see how many rounds of golf were played in June and July and August. So that data comes into this data room, and we can allow potential investors, these limited partners, to come in and take a look at it to convince them, hey, you know what, it's worth parting of our $30 million. So look on the far right in the purple box, legal, commercial, financial, oh my gosh, all these different kinds of things that are thrown into this data room. And, the Institute it's funny now, you get the sense of, they're evolving over time in presenting all of the material inside of its program. And so there's a definite move to include COVID kind of stuff. And so there's a little section in there on, hey, you know what? We learned how to use Zoom when we had COVID. At least something good came out of that thing. And so now this data room could be a virtual data room instead of having to drive over there and look in the basement, right? And you have to have your flashlight so no one can see what you're doing. Because remember, this is essentially private information. All right, let's move on to identifying a company business plan. You guys have heard me say this multiple times. At least I hope you've paid attention. What do I say about risk management? Identify the risk, quantify the risk, and then manage the risk. Now, that's clearly not what the Institute is trying to present to us here, but there are similarities. So look at this, the business plan, identifying opportunities. So what does this mean for our golf course example? It means identifying underperforming golf courses or golf courses that have potential to be leveraged to find growth opportunities, or alternatively, just pieces of land that are near, maybe creeks and lakes, or maybe an ocean or a mountain, because people like to play golf around that. So identifying those opportunities, which means that we need to look at the competition, we need to look at barriers, we need to look at the entire industry, and then what are those sources of return? I mean, for a golf course, clearly the first source of return are the greens fees paid by everybody who plays golf, including cart fees. But then, these people who play golf, apparently they get thirsty and they get hungry. So we have to feed them and offer them some kind of drinks, probably beer, right? And then after they're done, they want to go into the restaurant or the bar and they want to sit down and have another beer and maybe a hot dog or a hamburger. So we have all of these sources of returns. So there we go. What did I say? Identify, then quantify. So quantify the potential. And what this means is that we need to probably do some math. We need to estimate what those future operating cash flows might be, prioritize all the different strategies, investments, and changes. For example, there are some golf courses in my area that have low greens fees, and they cater to, just the kind of average working golfer out there who might spend 8 hours a day working in a factory and then wants to go play 9 holes of golf. That's fine, right? So there's lots and lots of growth opportunities there, all the way up to the elite golf courses. So prioritize all of those. And then evaluate risk. This, of course, means some more mathematics and quantitative methods. Find those key risk factors. I mean, you would think about, in our golf course example, one of those key risk factors is the average income of all of the people who surround the golf course, maybe 10 miles, maybe 20 miles, whatever that might be. And then I love this last one down here, and I'm so glad that the Institute mentions this. I would ask this question on the exam. I teach my students all the time how to perform a sensitivity analysis. We do this in a spreadsheet. You probably heard me say this before. So what we do is we say something like, suppose this variable changes, suppose this variable changes. Well, let's go ahead and recompute all of those cash flows over that time period. So we've got 2 phases here. What are we going to do? Construction phase, operational phase. That makes perfect sense. Sometimes if we just buy a golf course, we don't have to worry about the construction phase. And then, boy, we've seen due diligence multiple times throughout this slide deck. Yeah, what are we doing in this operational phase? Yeah, ensure that expected payments justify the associated risk. So however we identify risk, maybe it's standard deviation, maybe it's beta, maybe it's value at risk, maybe it's the hurdle rate, maybe, we got lots and lots of choices here. So we need to figure out what that hurdle rate is going to be and how we can compensate ourselves for taking that risk. Infrastructure assets, this is always interesting. Look down at the bottom. Our example here is wind power subsidy. So not only do you need to be an expert in wind and electricity, but you need to be an expert in contracts and dealing with the government. I said that before. So the project business plan, notice on the far right we have these steps, so we'll call these milestones. So what do we want to do? If we're buying a piece of land, what would those milestones be? The first milestone would probably be hiring an architect to come out and say, yeah, I can put hole 4 here and we can put the pond over here, et cetera, et cetera. And so each milestone would then be reached until we get to the income producing phase for the investors. Yeah, how about yet again some due diligence on the fund managers, but this time the limited partner. So what are we going to do? We're going to do this quantitatively and qualitatively. So what did I say earlier? I was the general partner and you guys were all the potential investors. What are you going to do? You're going to ask me for my experience. You're going to say, hey, Jim, are you a golfer, first of all? Do you know how to chip and putt? What kind of a driver do you use? And then maybe that's not the great level of experience. What experience do you have in running a golf course and in digging a ditch so that you have a creek? What's your track record? What's your investment strategy? And then, of course, you can do things like, hey, let's look at this average returns. Let's look at the internal rate of return. Let's look at the standard deviation return. Let's look at correlation. We can do all sorts of stuff. But then don't forget, in that quantitative analysis, you always have to decide what is the appropriate benchmark, and then how are we going to identify that benchmark. So here's a handful of slides on the exit strategy. What did I say earlier? We had that Club Corp had an exit strategy with an initial public offering, and then 5 years later they were taken private again. So there's a different exit strategy going on in the life cycle of that Club Corp. So that's pretty fascinating stuff. So publicly traded shares, all this stuff from level 1, don't you? Private sale, of course, this is just picking up the phone and calling people and say, hey, this golf course is for sale. Would you like to buy it? And it's probably not that easy. But of course, in the golf course ownership world, there's a network out there, and you can find who and when and where and what these people are interested in buying. Notice down at the bottom, private sale, speed, flexibility, cost advantages. So remember, here in the United States, we have the Security and Exchange Commission. I'll just go back here for a second. And what does the SEC require? Well, they require a whole bunch of stuff. And all that stuff costs time and energy and resources. Private sale, speed, flexibility, that should make perfect sense. So who's going to buy this golf course from us? A strategic buyer. So clearly that Apollo Global Management Group was part of this strategic buyer because they are going to find synergies with all the other stuff that it does. Management buyouts. Remember that managers or others, whether it's a management buyout, but usually it involves some kind of bond issue or bank loan. So that's why these things are typically called leveraged buyouts. And then financial buyers out at the end. Liquidation, what we can do is we can just say, you know what, we're done. We're closing down our golf course. Notice the second row there, common and failed startup companies that are funded by venture capital. So they're just failures. That makes perfect sense. Not viable as going concern. So what happens, we sell all the assets and then we take whatever proceeds are left and then we start paying off all the people on the right-hand side of the balance sheet. Yeah, why would we go through an IPO? High visibility, right? Wall Street Journal reports on this. If you watch CNBC or Fox Business News, they always say, hey, you know what? Here's the IPO. The initial price was $20. It went up to $28, and now it's down to $14. So it may lead to higher valuations, right? May lead to higher. Notice we didn't bold the may. We should probably say it could lead to higher. It might lead. Maybe someday it'll lead to higher valuations. Private sales, we have faster execution, might result in lower valuation. So that's probably a good exam question. May be higher for the IPO, may be lower for the private sale. Yeah, I don't really have an opinion on that. Yeah, the strategic buyer, what does this dude do? Maximizes value through synergies. So what are those synergies? Those synergies are on the income statement, revenue enhancements or cost reduction. So those synergies that occur there, that would be the strategic buyer, management buyer. This would mean something. And of course, management buyout, these might suffer from, a couple of other things down there that we've talked about in level 1 and in level 2. We need to worry about things like hubris, right? If we're the managers and we're running the company, but we've got owners over here who are nagging us, and we say something like, you know what, we'd be better off if we bought the company and we became the owners and then we ran the company. Well, there's a lot more to it than just managing. And then financial buyers over on the right. And that takes us through our learning outcome statement. So I want you to take some time and go through those 12 problems at the end of the learning module. There are 3 sets of questions, so 3 shorter vignettes. I'm pretty sure we covered most of those questions inside of this recording. So hey, thanks for watching. Have a great day and good luck studying.